So you're thinking about buying a home. You've heard that interest rates are high. You want to know what the interest rates are. Maybe you're even a little hesitant. Well, after this, hopefully you'll be more informed and feel a little bit more comfortable about buying a home. The interest rates are definitely high. They are higher than they've ever been since I've been in the business, and I've been in the business since 2003. So what I want to do is just pull back the curtain and really go deep on how interest rates are determined, where they come from, how they're affected by the different types of lenders, and also how the different types of lenders do lend in the form of transactional or relationship. So let's just start with where mortgage rates come from. Think of it as a clock. At 12 o'clock, you have mortgage-backed securities on Wall Street. Wall Street reaches out to the Fannie, Freddies, and Ginnies of the world. Ginnie Mae is, you may not have heard, it's just the government entities, FHA, VA, USDA. And they'll lend to the Wall Street will lend to them at 6%. And then Fannie, Freddie, Ginnie will reach out to the lenders, put their little profit on there of a quarter, for example. And the PNCs, Rockets, and Collab Lending, that's us. There's an interest rate that we are afforded, and then obviously no one works for free in the lending business, so they have to put a profit on there. And there's another quarter point at 6.5 that goes to the borrower. And I'll go deeper into the interest rates and how the flexibility with the interest rates, depending on what type of lender you are. And if you're wondering how it gets from the borrower to Wall Street, all you have to do is look at your retirement, or reach out to your HR person or your financial planner and look at your portfolio. There'll be some mortgage-backed securities in there. So that's the cycle of life of interest rates, and hopefully that clears it up a little bit for you. But then the big question: what's your interest rate? And there are 30 different factors that determine interest rate. I'm not going to go through all 30 of them. I have credit score and credit history on top there because they are really important. And that's the one people know the most about. But it's also the one where I get the most pushback when potential borrowers say, well, what's your interest rate, but don't pull my credit. And that's because they think that the pulling credit is going to drop your credit score. And that's not the case. As much as I think that the credit scoring companies are a racket, they get it right when it comes to mortgage. They look at mortgages as good debt because it's an appreciating asset. The confusion comes in because there is a hard pull with the mortgage. You can do a soft pull. Some lenders can do a soft pull on your credit. We're one of them. If you're just kind of kicking tires, that kind of thing. So we do have that option, but do not be afraid of the hard pull on a mortgage. It's not going to negatively affect your credit. They understand that you're going to be probably shopping for a mortgage, and as I mentioned, it is an appreciating asset. The hard pulls that will affect your credit negatively are the hard pulls for credit cards, because those aren't considered good debt, or for a car, an ATV, or a boat, because they are depreciating assets. So I wanted to make that clarification between the hard pull for a mortgage and a hard pull for what is considered bad credit. And if you do a hard pull or a soft pull, either one, it allows that mortgage lender to have a better idea of your situation and give you a better estimate. And that's really what you want to pre-qualify and to get pre-approved. And you can get in front of any issues that you may have. And there are 3 different types of lenders in general. And I want to just go through those. There's banks, there's correspondent lenders, and there's brokers. At the top, my experience in my 19 years, I've done 2 in a depository institution, like a bank you walk into. They have your checking and savings account. Correspondent lender, which is very similar to a bank, but correspondent lender is able to shop rates like a broker can. And that's been the majority of my career as a correspondent, working for correspondent lenders. And then brokers, I've been a broker 5 years. Then I have that 2-3 there, because my first go around, I was a broker for 2 years, and it was horrible because I had the lowest rates around, but my loans weren't closing. And it was like, well, what's the use of having the lowest rate if the loans don't close? And our defense, we were a very brand new brokerage, and the investors, the lenders that we were sending our loans to, they didn't know us. We didn't have any volume or any history with them, so they just weren't giving us love. But when you have, A paper clients and their loans are closing, especially if they're people that you know and love, it gets very frustrating. So I jumped out, and that's actually when I went to the bank, the depository institution, just for stability. And now I've been a broker for 3 years, the collab lending, and it's perfect. And I'll explain that to you. So let's look at the bank. What does the bank do? They get the application, they process the loan, they underwrite the loan, they lend the money, and they service the loan, meaning your mortgage payments go directly to that bank. And the advantage of that is you're controlling the process from beginning to end. That is a good thing. And sometimes, this wasn't the case with my bank. You can talk to the underwriters, but underwriters do not like loan officers bugging them, because if they have to field loan officer calls, they wouldn't be able to do their job. So that kind of depended on the bank whether you had access to an underwriter or not. The disadvantage is you only have that bank's product. The guidelines are a little more stringent. For example, most banks do not go below a 640 credit score, whereas as a broker, we can go down to 580. And then overhead. Each one of those, the processing, underwriting, lending, servicing, legal department, marketing department, there's people who work in those departments, and those people have to get paid. And how are they getting paid? Well, it's an interest rate. So that's the disadvantage. You'll tend to have the higher interest rates with those big box banks. A correspondent lender is very similar to a bank, as I mentioned. Only difference is they're not servicing the loan. They will sell it to whoever happens to have the best rates at the time you lock the borrower. But it's a nice little mesh. That's why I was in that so long, is because you got to control the process, but you got to shop the rates like a broker can. And just like the banks, the overhead is the disadvantage. That's built into your interest rate, so they'll tend to have the higher interest rates too. And then as a broker, you get the application. We just process it, collect the documentation, and then figure out, based on the borrower, and every borrower is different, who's the best lender for their particular situation. Maybe they're more forgiving on credit score. Maybe they have outside the box, non-Fannie or Freddie type loans, people that are self-employed that don't report all their income. So we just decide where it goes. And then obviously the advantages are being able to shop the rate. So brokers are going to have, in general, 9 times out of 10, the lowest rate. But again, having the lowest rate isn't always the best thing. Sometimes you get what you pay for. Then there's low overhead. We don't have all those different departments. We're usually we're a company of 25 people. We have an awesome operations department. So our loans do close, and that's sort of like the best of all worlds. Excuse me, is having the lowest rates, but also being able to close loans on time. For a purchase, my record's 14 days, and for a refinance, 9 days. And that was only because we did not have to do an appraisal, which is another great advantage. Some of the lenders that we work with, they'll let us, we can run it, whether it's Fannie or Freddie, and sometimes one and not the other will allow for a waiver on the appraisal. So it just gives you so much more flexibility. And I was talking about all the different loan products that we have. We deal with about 30 different lenders. And our wheelhouse, there's probably about 5 or 6 that kind of cover all our bases, whether it's a very vanilla loan or whether it's a really difficult loan because of credit score or some extenuating circumstance. We do commercial, so almost anything you need, we have available to us. And then, although I've probably talked to an underwriter 5 times in my whole career because I just don't want to bug them. Our team, my loan partners, they have direct access to the underwriter. So if I get a loan or something, and I have the ability to, if it's a difficult one, I'll have my loan partner say, hey, can you run this by the underwriter, see if we're good, and if we're not, how we get to good. and we can even do a to be determined underwrite, which means it's fully underwritten before they even find a house. And then usually with a broker, like in my first go around, control of the process was a huge problem. But you know, I jumped back in because I realized that our operations at Collab Lending was airtight, and they had been established in the broker world for a while, so they were getting love from everywhere we were sending them. So we do have control of the process. So like I said, I have, you know, the most competitive rates, but we also get to the closing table on time, which is very important for realtors. So there are different types of lending. There's transactional lending and relationship lending. When I started in the business, I was definitely a transaction lender because I was primarily doing lending tree, which I mentioned, and it is the shark infested waters that you saw in those commercials. You're competing with 3 or 4 different lenders, and there's so many legal loopholes to quoting rates that I was just getting my butt handed to me until I figured out what those loopholes were and how to fight it. Because I was actually giving rates I thought I could deliver, which is what I still do. And so what's really the difference between the transaction lending and the relationship? So most people start in their home search when they decide that they want to get a home is going online. This is bank rate. They have the fields predetermined in there. You can fill them in as what the purchase price, what zip code, a down payment, and it'll spit out who has the competitive rates. And as you can see, that second one down, it's 6.5% interest rate, 6.686 APR, and then upfront cost, which is the points that they're charging, is 5,419. Now, that is the important piece to the online shopping. Great place to start, but more often than not, they're not going to be able to deliver the rate that you see, and they're not going to have the closing costs that you're going to incur. It's really kind of cursory, in my opinion. And you always want to look at the small print, because knowing where the rates are, I'd look at that and say, well, there's going to be some points involved, and there usually is. Look for the fine print, and I'm going to show you that right below that 514.9. You hit that, you see the points, and it's a hyperlink which pops up this little narrative here, and it shows that what those points cost, and the point is 1% of the loan amount. But the math didn't work out when I did it, actually, but it's close. 5,419. So that's how much it would cost in points. And then you see below there, it says 8-year cost, 145,519. It is good to know what the loan is going to cost. You'll get a fee worksheet, which I'll show you here in a second. And the fee worksheet has your rate, all the fees broken down. And, I'll go through all that, and people will shop and compare the fee worksheets. But that 8-year cost, you click on that, and it's a very important piece of that puzzle. And I highlighted it. It says these estimates do not take into account principal payments, taxes, insurance, and additional payments or fees. And that the taxes and insurance, it's very important to know if those are included or not, because it's a very significant difference in closing costs and fees. Yeah, and fees. So I'm going to go through this whole thing with you so you can kind of see what the difference is, and that these estimates just always assume that the rate is way too low, and usually the costs and the closing costs are going to be way too low because they've left out so many of the important factors, those third-party fees that you incur no matter what lender you use. I mean, I sort of get that's why they don't put it in there, but you want to know, what you're going to have to write a check for. So that's where you start. That's where most people start, and then they'll just start dialing around or get a suggestion from a friend on, hey, this is what the interest rates are. So this is a fee worksheet. This is the top half of it. All lenders have something that look very similar to this, and normally you're going to see the lender fees, origination fees in the top left corner. I highlighted the points. I went in and just did essentially tried to do an apples to apples to what bank rate was doing. So it was pretty close, not exact, but those are the fees that you want to look at when you're trying to compare, because all the other fees are third-party fees that you're going to incur no matter who you're dealing with. And then if you look over to the right, there's no escrows. The prepaids and initial escrow payments at closing. Just again, to mirror what bank rate was doing, I came up with this fee sheet. And then on the second, at the bottom part, is like what your principal and interest payment is at 1796, which is the number you saw on the bank rate. And then the closing costs here is 86,136. That's down payment and closing costs all in. And that's an important number that we'll address again. But I mentioned no escrow and escrow. There is a big difference between what the closing costs are if you escrow and if you don't escrow. So what does it look like if you escrow, meaning including your taxes and insurance in your payment? That is a matter of a personal preference. If you put 20% down, you do not have to escrow. Some people sleep better at night knowing that they're going to be those taxes and insurance are going to get paid on their own. First-time home buyers, they're usually not putting down 20%. So they'll put down 3.5% or 3% or 5%. So they're going to have mortgage insurance and they're going to have to escrow. For first-time home buyers, it's good to be escrowing and get used to that process. But once you've had a house or two or three, and you have a credit score over 700, that implies that you're a good steward of your money, and you can pay those things on your own and let that money sit in your bank account and earn for you instead of paying a bank to teach you the discipline of doing it. We're doing it yourself. So what does the escrow look like? The points are still there in the lender fees, but now you have all these escrow collections, the prepaids. This is to set up your escrow account. It's usually a year ahead. In my estimates, I'll do 13 months for taxes and insurance just to have a cushion, because you really don't know what they're going to ask, what's going to be required from the lender to collect an escrow. So I like to have my estimates high and come down. And when I'm talking to estimates, I'm talking about cost estimates and rate estimates. And so that I much rather my clients end up with a lower rate and lower closing costs than they expected in the beginning. But with the escrows, you'll see the closing costs are almost $7,000 more because they are collecting your escrows, and you'll see that here. Here's a payment with I just did 104 in homeowners insurance, and then 373 in monthly taxes, and that's 2273 for a mortgage payment. And here 92,008, almost 93,000 is your closing costs. So that's because if you look back, the no escrow is 86 and with escrow 92. So that difference is that collecting of the escrows. And 90% of the let's call it the fintechs, the Rockets, loan depots, this is kind of what you're going to be told or shown when you're shopping for a mortgage. Important information. You want to know what your payment's going to be. You want to know what your rate's going to be. And you're going to want to know what the final number is of the check you have to write to get into the house. But because so many people's lives are so different and situations are so different, there really needs to be a little bit more information. You know, a military person, they're moving every 2 to 3 years. Do they need to have a 30-year fixed? Maybe. But that gets into relationship lending. So when someone asks me what the interest rate is, I'll always ask, well, what are you trying to accomplish? What are your goals? If they have a family, if they have kids, maybe their kids are going to be graduating and going to college, that weighs into the financial picture. So there are a bunch of questions that I ask when I'm doing a consult. And because I'm a relationship guy. I could do the transactional lending, and like I kind of gauge it based on the people. But I was doing a lot more transactional lending when I started. But as I showed you right at the top, everybody gets the rates from the same place, so they all should be within reason. The difference between a broker and a bank might be 0.5%, but that's still, depending on how much the sale price is, it might not be a huge difference. So I didn't want to be in a commodity game anymore. I wanted to provide some value with mortgage advising. So the first thing I'll do is when someone asks me what the rate is, and looking at that bank rate, I just went to the most competitive lender that I deal with for my vanilla loans, and looked to see what I went to see what their rate was, and you see I highlighted 6.5, and it's saying 2.5 points. Well, the bank rate quote was 1.5. Now I know that bank rate is not going to be what they can deliver. So I at least want to get close and be like maybe at 2. So because I'm a broker, I can shop around and see who like all the big lenders out there. So I plug in the same parameters that bank rate had, and I pop up and I see the lender that has the best rates. And 100.000 is a par rate. And banks and brokers on average will be making between 2 and 3 points on a loan. With the banks, it'll be higher and more closer to 3. With the brokers, it'll be lower and more closer to 2. So I just went with this for the sake of this example and said, all right, well, we can go with this lender and we'll do 2 points. And because you saw this rate on bank rate, I will explain why it's such a much lower rate and there's points involved. Well, do you want to be paying points? There's a way to determine that. So what I do is give them 3 options. So 0 points, 1 point, and 2 points. Pluses and minuses to all of them. The 0 points is going to give you lower closing costs, but the interest rate is 7.625. 1 point is going to be 7.125, and 2 points is 6.5. So this third column is essentially the apples to apples to bank rate. The APR, remember bank rate was 6.686 APR. Know that banks, the calculation for APR, banks use different numbers in the fees to come up with it. So that's even hard. You just want to have like a ballpark. And so 6.723 is pretty close to what bank rate was offering, but I put all the fees into the closing costs. Bank rate didn't. So essentially, I have the ability to match anybody out there, and because this is no escrow, you see the principal and interest is the same as the total monthly payment, which I highlighted, and then the closing costs. 0 points is 80,000. 1 point is 83,000 and some change, and then 2 points is 86,000 and some change. The difference being the points. And here are the points right here. And then I also want to show the escrow option. And that difference is going to be, the interest rates are going to be the same, but the difference is going to be that you're adding another almost $7,000 to your closing costs because the escrows are being collected. That's why these numbers are higher. Going back to no escrow, escrow, no escrow, escrow. And that's a conversation that goes on too with the client. Is you're paying payment or is you're paying closing costs? Because if it's payment or down payment and closing costs, then it's almost a no-brainer to go with the 0 points. If the higher interest rate is 7.625 is doable, and you can save some money, keep money in the bank. I'm a big fan of not burning all the liquid cash that you have in checking and savings to get into a house. I like to see my clients have a little bit of money left over for furniture or new things for the house, new carpet, new paint, that kind of thing. So I don't ever let a client come to the table and then have nothing left over in their bank account. And if you remember that from bank rate and the 8-year cost, it is good to know what the cost of the loan is over time. And that's going to vary from borrower to borrower. And since bank rate was using 8 years, I did 8 years, except I included all the fees that bank rate didn't, that highlighted part. So you have 161,995. That's a huge difference from the 145, but as they said, we're not putting it all in there. Now, if you're a borrower, wouldn't you want to know that over time that cost is going to be $30,000, $40,000 more? Actually, it's $20,000 in these examples. The difference between 0 point, 1 point, and 2 points is $20,000. Now that's 8 years. That's an 8-year snapshot. Well, there's some other things you have to look at too. How much principal and interest are you paying over those 8 years? So we'll go over that, and you'll see that the 2 points is obviously the more favorable because you're paying less interest and more principal than the 2 point option for 8 years out. So I could stop there, and to a borrower, it's like, oh, well, then I should take the 2 points. But I know because I follow the market. I'm a big fan of Barry Habib. If you Google him, you'll find out he is the Obi-Wan of following the market. Interest rates are going to come down. So there's a break-even analysis that I'll show you here. Here's what 1 point equals and 2 points. You've seen those numbers before. And what's the difference between no points and 1 point? $97 a month. And the difference between 0 points and 2 points is $168 a month. So what it's saying is for $2,842, you're saving $97 a month. And for $5,683, you're saving $168 a month. What's the break even on that? And here you see it's for 1 point, the break even is just past 2 years. And for 2 points, it's just under 3 years. But as Barry Habib and all the guys who spend their whole day and make their career on following the market, they say the rates are going to drop between 6 and 18 months. Now, I've been following them since I got in the business, and they have saved myself and my clients hundreds of thousands of dollars. So the likelihood that those rates are going to drop is much higher than if they're going to stay the same or go up. So what does that mean? Well, you maybe 2 years, within the next 2 years, you're going to be refinancing. So why pay that upfront cost of $2,800 or $5,600 if you're going to be refinancing? Why not save that money for the transaction cost of refinancing, because the rates are going to drop? And so I did that same total cost of a loan over 2 years, and where it was $20,000 difference between the 0, 1, and 2 points. 2 years is only $780, but you're saving yourself $2,800 or $5,600 by not buying down the points, and you're going to be refinancing. So again, this is mortgage advising. The numbers don't lie. Now, someone may say, I'll show this, and they still may say, all right, well, I still want to buy the points. And when I was younger, I would say, why? This doesn't make sense. But now it's like, well, my job is just to show the options and let them decide, but to have them make that decision based on all the information. So yeah, that's this tells me that I would go 0 points, take the highest interest rate because you're not going to be in it that long, as long as it's a comfortable payment. And then you're going to refinance, and you're going to save yourself, thousands of dollars. And you're also going to end up saving yourself, tens of thousands of dollars in a lower interest rate over the term of the loan. And I just wanted to show you that the total paid is about the same in the 2-year window. So there isn't really an advantage to buying down the points, no matter how you look at it, buying down the rate with points. So what have I explained here? Just the review. Rates come from the same place. You're getting competitive rates. There should be no more than, I've said that a bank and a broker can be at 0.5 point apart, but in normal cases, it's not going to be more than a quarter or 0.375. There's nothing wrong with starting online. And the transactional, like there are guys who are killing it doing transactional lending. You're just a number. They're just doing volume. It's like a factory, an assembly line. Nothing wrong with that. And like I said, people doing very well doing it that way. I'm just I like people, and I like making friends, and I like informing my clients so that although they're not going to be mortgage advisors like me, they're going to know enough to be dangerous by the time I educate them throughout the process. Remember, there's 30 different factors when you to determine the rate. So what's your rate to me is just saying, I want you to treat me fairly. I don't want you to screw me with the interest rate. And I want you to give me good service. That's what your rate means to me. And through the way I advise, that fee worksheet that I started with in the transactional, that's kind of two-dimensional to me. I want to do 3D advising. And so that's why I use the graphs and charts and the more accurate cost of the transaction. I talked about the three types of lenders and their strengths and weaknesses. If you can find a broker like Collab, and I'm sure there's others out there. We're in a community. The thing I love about the people I work for is they come from a position of abundance, not scarcity. So we are all a part of mastermind groups of the best mortgage people in the business, and we exchange best practices and share information and try to bring the broker community up. And we're taking over a lot of market share, especially in a high interest rate market, because we just have more flexibility on what rates we can deliver. And then the total cost of the transaction is a number that borrowers should know, as you've seen in this example. And just weigh the break even on whether you should be buying down points or not. Back in 2020, in the middle of the pandemic, huge refi market. Everybody, it just made sense for everybody to buy down the rate and pay a point or two to get that lowest interest rate. I have clients that have, in the low two. So I think 2.375 was the lowest I locked on the 30-year rate, which is amazing. This year in January, the rates are 3.5. Now they're at 7. They've doubled, but it's still a great time to buy because the real estate is going to be appreciating 5 figures, and you may be paying an extra couple hundred in monthly payment. So that appreciation is always going to outpace the difference in interest rate. So like the last part there, in general, it's just not worth paying points for a lower rate right now unless you need it to qualify. If your debt to income is too high, and you need to have a lower rate to qualify, that's a whole nother conversation that I can talk about. But that's it. If you want to do a deep dive or have me run the numbers for you, you can always reach out to me. I'm happy to do it. That's what I do all day other than do podcasts. And please follow me on social media. Like, share, follow, and I would love if you would subscribe to my YouTube channel. I'm trying to grow that community. There's a bunch of videos just like this in there too. So have a fantastic day, and thank you for your time.